The school system taught you everything except the one skill that actually determines whether you'll be rich or poor for the rest of your life. Think about all those years you spent in classrooms. Math, science, history, literature, thousands of hours absorbing information. But when was the last time anyone taught you how to read a balance sheet? How to understand cash flow? How to distinguish between an asset that builds wealth and a liability disguised as an asset? Never, right? That's not an accident. And today, we're going to explore exactly why financial literacy matters more than almost any other form of education you'll ever receive. I'll never forget the moment this became crystal clear to me. I was sitting across from my accountant, staring at numbers on a page that might as well have been written in a foreign language. I'd worked hard, earned decent money, but I had absolutely no idea whether I was actually building wealth or just spinning my wheels. That feeling, that helplessness when confronted with your own financial reality, that's what happens when you lack financial literacy. Robert Kiyosaki's second major lesson in Rich Dad, Poor Dad addresses this head-on. Financial literacy isn't just nice to have. It's the fundamental skill that separates those who build lasting wealth from those who work their entire lives and have nothing to show for it. So what exactly is financial literacy for? Here's the truth that nobody wants to say out loud. Financial literacy exists to give you control over your economic destiny. Without it, you're at the mercy of employers, banks, financial advisors, the government, and every other entity that benefits from your ignorance. Harsh? Maybe, but accurate. Kiyosaki tells the story of his two dads again, and the contrast is striking. Poor dad had a PhD, impressive credentials, deep knowledge in his field. He could discuss complex academic theories for hours, but when it came to understanding how money actually works, he was functionally illiterate. Rich dad, on the other hand, never finished high school, but he could read financial statements like most people read novels. He understood tax codes, investment vehicles, business structures, and cash flow dynamics. That knowledge, not his formal education, is what made him wealthy. The key insight here is this: traditional education prepares you to be an employee. Financial education prepares you to be an owner. There's a massive difference between those two paths, and it all comes down to literacy. Specifically, the ability to read and understand the language of money. Let me break down what financial literacy actually means in practical terms, because this isn't abstract theory. This is the toolkit that changes lives. Financial literacy starts with understanding the difference between assets and liabilities. We touched on this in the previous lesson, but it bears repeating because most people get this wrong their entire lives. An asset puts money in your pocket. A liability takes money out of your pocket. That's the only definition that matters when you're trying to build wealth. Your primary residence, if you're paying a mortgage, property taxes, insurance, and maintenance without generating rental income, it's a liability. Yes, it might appreciate in value over time, and yes, you need somewhere to live. But from a cash flow perspective, which is what financial literacy focuses on, it's taking money out of your pocket every single month. Now, if you house hack and rent out rooms, or if you buy a duplex and live in one unit while renting the other, suddenly you've converted what would be a liability into an asset. Same property, different structure, completely different financial outcome. That's what financial literacy allows you to do. Structure your finances in ways that serve your wealth building goals rather than working against them. Kiyosaki emphasizes something profound in the book. Most people spend their lives acquiring liabilities they think are assets. They buy cars, boats, vacation homes, designer goods, all things that consume money rather than generate it. Then they wonder why they're working harder than ever but never getting ahead. The financially literate person approaches purchases completely differently. Before acquiring anything significant, they ask, what is the cash flow impact of this decision? Will this generate income or consume it? Does this move me closer to financial independence or further away? I started applying this framework to every financial decision I made, and it was eye-opening. Suddenly, I could see exactly where my money was going and whether those decisions were building or eroding wealth. That clarity, that's what financial literacy provides. But it goes deeper than just assets and liabilities. True financial literacy means understanding the four fundamental components of financial statements: income, expenses, assets, and liabilities. Rich Dad taught young Robert to think about these four elements as parts of a machine. Money flows through this machine in predictable patterns, and understanding those patterns is the key to building wealth. For poor and middle-class people, the pattern looks like this. Money comes in as income and immediately flows out as expenses. Whatever's left, if anything, might go into savings or get spent on liabilities. For wealthy people, the pattern is different. Money comes in as income, gets directed toward acquiring assets, and those assets generate more income. That additional income can be used to acquire more assets, creating a compound effect. Same four components, completely different flow pattern, entirely different financial outcome. When I finally understood this, truly understood it at a visceral level, everything changed. That shift in perspective is what financial literacy creates. Let me give you a concrete example of how this plays out in real life. Imagine two people, both earning $70,000 a year. Person A takes that income, pays rent, covers living expenses, buys a nice car on credit, goes on vacations, and lives a comfortable lifestyle. At the end of each year, they have maybe a few $1,000s saved, if anything. Person B takes that same income, lives more modestly, keeps expenses low, and systematically directs 20% of their income toward acquiring assets. They buy their first rental property. They invest in dividend-paying stocks. They build a small business on the side. 5 years later, person A is still earning $70,000, still living paycheck to paycheck, with maybe $15,000 in savings. Person B has built a portfolio of assets generating $1,500 a month in passive income. Their net worth has grown substantially. They have options and flexibility that person A doesn't have. 10 years later, the gap is even more dramatic. Person A might be earning $85,000 now, but they're still trapped in the same pattern. Person B's assets are now generating $4,000 a month, more than half their expenses covered by passive income. Same starting point, completely different trajectories. The difference? Financial literacy and the decisions that flow from it. Now here's where most people get stuck. They hear about financial literacy and think, I should probably learn about that someday. But someday never comes. Or they feel overwhelmed by the complexity and never start. But here's what Kiyosaki emphasizes. Financial literacy isn't about becoming an expert in everything. It's about understanding the fundamentals well enough to make informed decisions and recognize opportunities. You don't need a finance degree. You need to understand how money flows, how assets work, how taxes impact your wealth, and how to read the basic financial statements that govern your economic life. That knowledge is accessible to anyone willing to invest the time to learn it. I spent years feeling intimidated by finance. I thought it was this complex, specialized domain reserved for experts. Then I started actually studying it, reading books, taking courses, analyzing real financial statements. And I realized something surprising. The fundamentals aren't that complicated. They've been made to seem complicated, which serves certain interests, but the core principles are actually quite straightforward. Income minus expenses equals cash flow. Assets generate income. Liabilities consume income. Compound growth accelerates wealth accumulation over time. Tax efficiency dramatically impacts net returns. These aren't mysterious concepts. They're learnable, applicable principles that anyone can master with focused effort. And here's the thing that really matters. Every piece of financial knowledge you acquire has immediate practical value. Unlike a lot of academic learning that might never get used, financial literacy applies to decisions you're making every single day. Should you lease or buy that car? Financial literacy gives you the framework to answer that question based on actual numbers, not emotions or marketing. Should you put money in a retirement account or invest in real estate? Financial literacy helps you evaluate the tax implications, return potential, and risk profile of each option. Should you start that business idea you've been thinking about? Financial literacy lets you model the potential outcomes and assess whether the opportunity justifies the risk. Every financial decision you face, financial literacy makes you better equipped to navigate it successfully. Before we go further, I want to hear from you. Drop a comment right now telling me what city you are watching from and what specific action you are taking to improve your financial literacy. Are you reading investment books, taking online courses, working with a mentor, analyzing your own cash flow? Share it below. Your commitment might inspire someone else to take their first step. Now let's talk about something Kiyosaki emphasizes heavily: the relationship between financial literacy and taxes. This is where financially illiterate people lose massive amounts of wealth without even realizing it. Poor Dad believed in working hard for money and paying whatever taxes the government demanded. He saw taxes as an unavoidable burden, something you just accept as part of life. Rich Dad had a completely different perspective. He understood that tax codes are actually written to incentivize certain behaviors, particularly behaviors that benefit the economy, like investing in real estate, starting businesses, and creating jobs. The financially literate person learns to structure their income and investments in ways that take advantage of these incentives, legally minimizing their tax burden and keeping more of what they earn. Let me be clear. I'm not talking about tax evasion or anything unethical. I'm talking about understanding the legal structures and strategies that wealthy people have used for decades to build and preserve wealth. For example, earned income, the money you get from a job, is taxed at the highest rates, but income from investments, particularly long-term capital gains and qualified dividends, is taxed at much lower rates. The financially literate person understands this distinction and structures their wealth-building strategy accordingly. They work to transition from earning primarily through labor to earning primarily through assets, which has enormous tax advantages. Or consider real estate. The tax code offers incredible benefits to real estate investors. Depreciation deductions, the ability to defer taxes through exchanges, deductions for expenses and interest. These aren't loopholes, they're intentional incentives designed to encourage investment in housing. But if you're financially illiterate, you don't even know these advantages exist. You pay full taxes on earned income, never realizing there are entirely legal ways to keep significantly more of what you make. This is exactly what Kiyosaki means when he talks about the wealthy playing a different game. It's not that they're cheating, they're simply financially literate enough to understand the actual rules and structure their finances accordingly. When I first learned about these dynamics, I was honestly frustrated. Why hadn't anyone taught me this earlier? Why did I spend so many years paying maximum taxes when there were legal strategies I could have been using? But frustration doesn't help. Education and action do. I found a good accountant who specializes in working with investors and business owners. I started learning about tax advantage accounts, business structures, depreciation schedules, and strategic timing of income and expenses. My tax situation improved dramatically. Not because I was doing anything shady, but simply because I became literate in an area I'd previously ignored. That's what financial literacy does. It opens up strategies and opportunities that remain invisible to the financially illiterate. Another crucial aspect of financial literacy that Kiyosaki emphasizes is understanding how to evaluate investments and opportunities. Most people make investment decisions based on emotions, tips from friends, or whatever is being hyped in the media at the moment. That's not investing, that's gambling. The financially literate investor knows how to analyze an opportunity using concrete metrics. What's the potential return? What are the risks? What's the cash flow projection? How does this fit into my overall portfolio strategy? Let me give you an example. A few years ago, a friend was raving about a real estate investment opportunity. "You can't lose," he said. "Property values are going up and the rental income is guaranteed." All me might have jumped in based on enthusiasm and FOMO, fear of missing out, but by this point I had developed enough financial literacy to ask the right questions. What was the actual cap rate, the return on investment based on rental income? What were the vacancy rates in that market? What were the property taxes and insurance costs? What was my exit strategy if I needed to sell? What were comparable properties selling for, and was this priced reasonably? When I ran the numbers, the opportunity looked far less attractive than my friend's enthusiasm suggested. The projected returns assumed continuous rent increases and zero vacancies, which was unrealistic. The property was priced at the high end of the market. The cash flow was actually negative when you factored in all the costs. I passed on the opportunity. My friend invested. 2 years later, he sold at a loss after dealing with problem tenants, unexpected repairs, and market softening. That's what financial literacy provides, the ability to evaluate opportunities critically using actual data rather than emotions and hype. This doesn't mean you never take risks. Building wealth requires taking calculated risks. But calculated is the key word. You're assessing the risk-reward ratio using concrete analysis, not just hoping for the best. Kiyosaki also talks about understanding different investment vehicles and their characteristics. Stocks, bonds, real estate, businesses, commodities, precious metals, each has different risk profiles, return potential, liquidity characteristics, and tax implications. The financially literate person doesn't just pick one and hope it works out. They understand how different assets behave in different economic conditions and build diversified portfolios that can weather various scenarios. They know that stocks offer growth potential but can be volatile, that real estate provides cash flow and tax benefits but requires active management or property managers, that bonds offer stability but lower returns, that businesses can generate substantial wealth but require significant time and expertise. This knowledge allows them to make strategic allocation decisions based on their specific goals, timeline, and risk tolerance. When I was financially illiterate, my investment strategy was putting money in whatever my employer's retirement plan offered and hoping it would somehow grow enough for retirement. I had no idea what I was actually invested in, what the fees were, or whether the allocation made sense for my situation. As I developed financial literacy, I took control of these decisions. I understood what I owned and why. I could evaluate whether my portfolio allocation matched my goals. I could assess whether I was paying reasonable fees or getting overcharged. That shift from passive hoping to active understanding, that's empowerment. That's what financial literacy creates. Let's talk about something else Kiyosaki emphasizes. Understanding the difference between working for money versus having money work for you, and how financial literacy is the bridge between those two states. When you work for money without financial literacy, you're essentially on a treadmill. You earn, you spend, you earn more, you spend more. You might accumulate some savings, but you're not building true wealth because you do not understand how to make your money generate more money. Financial literacy teaches you to think about money as a tool, capital that can be deployed to generate returns. Instead of money being the end goal, it becomes the means to acquire income-generating assets. This is a fundamental shift in relationship with money, and it only happens through education. I used to think about my paycheck as money to spend on living expenses and hopefully save a bit, and now I think about it as capital to deploy toward asset acquisition. Same money, completely different mental framework, entirely different outcomes. That reframing came directly from developing financial literacy. Here's another critical element: understanding leverage and how to use it responsibly. Leverage, using borrowed money to amplify returns, is one of the most powerful tools in wealth building. It's also one of the most dangerous when used irresponsibly. The financially literate person understands both the power and the risk of leverage. They know that borrowing money at 5% to invest in an asset that returns 10% can dramatically accelerate wealth accumulation. They also know that excessive leverage can lead to catastrophic losses if things don't go as planned. This nuanced understanding allows them to use leverage strategically, taking on good debt that finances income-producing assets, while avoiding bad debt that finances consumption and liabilities. Most people only know about bad debt. They borrow for cars, credit cards, lifestyle expenses. That debt erodes wealth because it's financing consumption rather than investment. The wealthy use good debt constantly. They use mortgages to buy rental properties where the rent covers the debt service and then some. They use business loans to expand operations that generate returns exceeding the interest cost. They use margin strategically in investment accounts when opportunities arise. Same tool, debt. Completely different applications and outcomes based on financial literacy. When I bought my first rental property, I used leverage. I put down 25% and financed the rest. The property now generates positive cash flow every month, and I control an asset worth significantly more than my initial investment. Without that loan, I would have had to save for years to buy the property outright. With leverage, I was able to acquire it much sooner and start generating returns immediately. But here's the key. I only took on that debt because I had developed enough financial literacy to analyze the deal properly, ensure the numbers worked, and understand the risks I was taking. That's responsible leverage, and it's only possible with financial education. Kiyosaki also emphasizes understanding how corporations and business structures work and how they're used to build and protect wealth. Most people only know about being an employee of a corporation. The financially literate person understands how to use corporate structures, LLCs, S Corp, C Corp, to operate businesses, manage investments, and optimize taxes. This isn't about being shady or hiding money. It's about understanding the legal structures that wealthy people have used for generations to build and preserve wealth more efficiently. For example, when you earn money as an employee, the sequence is earn money, pay taxes, spend what's left. When you earn money through a business structure, the sequence can be earn money, spend on legitimate business expenses, pay taxes on what's left. That difference, being able to deduct legitimate business expenses before paying taxes rather than after, can be substantial over time. Or consider asset protection. When you own valuable assets personally, they're potentially at risk from lawsuits, creditors, and other liabilities. When you own them through properly structured entities, you can create legal separation that provides protection. These strategies aren't secrets. They're standard practices among wealthy individuals, but they remain unknown to most people because of financial illiteracy. When I started my first business, I did it as a sole proprietor because I didn't know any better. A mentor eventually explained how I was leaving money on the table and exposing myself to unnecessary risk by not using proper business structures. I restructured everything and the benefits were immediate. Better tax treatment, liability protection, more professional appearance, easier to separate business and personal finances. That knowledge came from developing financial literacy, and it's had lasting impact on my wealth building. Let me address something important. Financial literacy isn't just about making more money or building wealth, though those are certainly outcomes. It's fundamentally about having control over your economic life, rather than being controlled by circumstances, employers, or ignorance. Think about how much anxiety and stress people experience around money. Bills they can't pay, unexpected expenses they're not prepared for, career uncertainty, retirement fears. That stress comes largely from a sense of helplessness, not understanding how money works or how to improve your situation. Financial literacy reduces that helplessness. It gives you frameworks for understanding your financial reality and tools for improving it. Even if your situation is challenging, knowing what to do about it is far less stressful than feeling completely lost. I remember the anxiety I used to feel every time I looked at my bank account or thought about the future. It wasn't just that I didn't have as much money as I wanted, it was that I felt powerless to change the situation. Developing financial literacy didn't instantly make me wealthy, but it gave me a clear path forward. I could see exactly where I was, understand why I was there, and identify specific steps to improve things. That clarity reduced anxiety dramatically, even before my financial situation substantially improved. That psychological benefit, feeling in control rather than helpless, that alone makes financial literacy worth pursuing. Now let us talk about another aspect Kiyosaki emphasizes: understanding how money is created and how the monetary system actually works. Most people think money is just this fixed thing that exists. They don't understand that money is constantly being created and destroyed, that central banks manipulate interest rates and money supply, that inflation systematically erodes purchasing power. The financially literate person understands these dynamics and adjusts their strategy accordingly. They know that keeping large amounts of cash in savings accounts means losing purchasing power to inflation every year. They know that when interest rates are low, it favors borrowers and investors. They know that when governments print money, it tends to inflate asset prices. This macro-level understanding informs micro-level decisions about how to allocate capital and structure finances. For example, right now we're in an environment where inflation has been significant. The financially illiterate person just complains about rising prices. The financially literate person understands that during inflationary periods, owning hard assets, real estate, businesses, commodities, tends to preserve wealth better than holding cash. They adjust their portfolio accordingly, shifting from cash into assets that can maintain value or even appreciate during inflation. That's strategic adjustment, and that's only possible with financial education. Another crucial element of financial literacy is understanding cash flow versus net worth, and why cash flow is ultimately more important. Net worth is a snapshot. What you own minus what you owe at a specific point in time. It's a useful metric, but it doesn't tell you whether you can actually afford your lifestyle. Cash flow is about movement. How much money is coming in versus going out on an ongoing basis. This determines your actual financial sustainability. You can have a high net worth but poor cash flow, lots of assets but no income to cover expenses. That's actually a precarious position, potentially requiring you to sell assets to meet obligations. Or you can have a modest net worth but strong, positive cash flow. Your assets generate more than enough income to cover expenses. That's financial freedom, even if the net worth number isn't impressive by conventional standards. Kiyosaki emphasizes this distinction repeatedly. Rich Dad focused on building cash flow through income-generating assets. Poor Dad focused on accumulating things that looked impressive but didn't generate income. The financially literate person prioritizes cash flow. They understand that ultimately, cash flow is what provides freedom and security, not just the nominal value of assets you own. When I shifted my focus from growing net worth to building cash flow, everything changed. Instead of just trying to accumulate more money in accounts or increase property values, I focused specifically on acquiring assets that generated monthly income. That monthly income, that's what actually changed my life. Not the net worth number on a statement, but the cash flowing in every month that reduced my dependence on employment income. That understanding, that shift in focus, came directly from financial education. Here's something else critical. Financial literacy includes understanding your own psychology around money. We all have emotional relationships with money shaped by our upbringing, experiences, and beliefs. These emotional patterns drive behavior, often in ways that work against our financial interests. Some people are anxious about money and hoard cash, missing investment opportunities out of fear. Others are impulsive spenders who can't delay gratification. Some tie their self-worth to material possessions. Others feel guilty about having or wanting money. The financially literate person recognizes these patterns in themselves and develops strategies to make better decisions despite emotional pulls. They might set up automatic transfers, so investment happens before they can spend impulsively. They might implement waiting periods before major purchases to ensure they're not buying emotionally. They might work with accountability partners or advisors to counteract their own behavioral tendencies. This self-awareness and behavior management, that's part of comprehensive financial literacy. I had to confront my own patterns. I realized I was using shopping as stress relief, spending money whenever I felt anxious as a way to feel temporarily better. That pattern was sabotaging my wealth building. Once I recognized it, I could address it, finding healthier stress relief methods and putting systems in place to prevent impulse spending during moments of emotional weakness. That work on myself was just as important as learning about investments and tax strategies. Let me share something Kiyosaki emphasizes that many people miss. Financial literacy is not a destination you reach. It's an ongoing practice. The financial world is constantly evolving. Tax laws change. New investment vehicles emerge. Economic conditions shift. Technology creates new opportunities and challenges. The financially literate person commits to continuous learning, staying current with changes that affect their wealth building. They read books, follow market news, take courses, attend seminars, join communities of other investors and entrepreneurs. They treat financial education as a permanent part of their life, not something they do once and check off a list. This commitment to ongoing learning is what allows them to adapt as conditions change and continue building wealth across different economic environments. I've made financial education a permanent part of my routine. I read at least one finance or business book every month. I listen to podcasts from investors and entrepreneurs. I'm part of mastermind groups where we share strategies and lessons learned. That continuous learning has been one of the highest return investments I've ever made. The knowledge compounds, and the opportunities I can recognize and capitalize on have multiplied over time. Here's what really matters as we think about this lesson on financial literacy. It's the great equalizer. You might not have been born into wealth. You might not have had access to elite education. You might not have powerful connections. But financial literacy is accessible to anyone willing to invest the time and effort to acquire it. Books, courses, mentors, online resources. The information is out there, often free or inexpensive. And once you have that knowledge, no one can take it away from you. It becomes a permanent asset that generates returns for the rest of your life. That's the profound opportunity here. Financial literacy is the tool that allows people from any background to build wealth and achieve financial independence. But it requires making a choice to prioritize learning about money with the same seriousness you might have prioritized school or career training. Most people won't make that choice. They'll remain financially illiterate their entire lives, wondering why wealth always seems just out of reach. But you're here, watching this, which means you're already different. You're already investing in your financial education, which is the first and most important step. So what's the practical takeaway from this lesson? Start building your financial literacy systematically. Don't try to learn everything at once. That's overwhelming. Instead, pick one area to focus on first. Maybe it's understanding your personal cash flow, tracking every dollar coming in and going out for a month to see exactly where you stand. Maybe it's learning to read basic financial statements so you can understand what numbers actually mean. Maybe it's researching your first investment vehicle, understanding how stocks work, or real estate, or starting a business. Pick one area, learn it thoroughly, apply what you learn, then move to the next area. Over time, those individual pieces of knowledge combine into comprehensive financial literacy that transforms your economic life. Kiyosaki's lesson here is clear. Financial literacy isn't optional if you want to build wealth. It's the foundation everything else rests on. Without it, you're flying blind, making decisions based on hope and guesswork rather than analysis and strategy. With it, you have clarity, confidence, and control over your financial destiny. That's what financial literacy is for. It's the tool that transforms your relationship with money from reactive and fearful to strategic and empowered. Your financial education is the one investment that will pay returns for your entire life. Every book you read, every course you take, every concept you master, it all compounds into capability that generates wealth year after year. Start today. Start small if you need to, but start. Your future self will thank you for the decision you make right now to prioritize financial literacy. If this lesson resonated with you, make sure you are subscribed because we are continuing through all the essential principles from Rich Dad, Poor Dad, and beyond. This is a journey, and we're taking it together. More importantly, take action on what you learned. Don't let this be passive entertainment. Let it be the catalyst for real change in your financial life. Your wealth, or lack of it, is being determined right now by the knowledge you have and the decisions you make. Choose to be financially literate. Choose to understand money rather than being mystified by it. Choose to build wealth rather than just earn income. That choice changes everything. Thanks for watching, and I'll see you in the next one.